Good afternoon, everyone. Today's Friday, the 18th of May, 2012, and this is Brian Shannon from Alphatrends.net speaking. Let's take a look at the damage this week. We saw a pretty good sell-off. Actually, the S&P 500 was down 4.5%, Nasdaq down 5.25%, semiconductors down 6.5%, and all these markets that were up double-digit percentage-wise just a couple weeks ago are now really just struggling to hold on to positive year-to-date with the Russell 2000 just up 1.1%. So we've had a lot of volatility here. Gold went negative year to date for a day, and then was bought in there. And I think it's Stephen Place always likes to point out that gold oftentimes, when it looks like it's broken, is the time to buy it. That is, when we break these support levels and it just went negative for the week. Now it's probably just a bounce, but I'm not a gold trader, so I don't really want to talk about that too much. Let's go back to the S&P 500. We're also going to talk about Facebook and Apple and some other interesting stocks here. But the S&P 500, we're down just above the 200-day moving average. We have the fourth quarter little spike high, just really right where we are right now. In fact, let's take a look at that number together. The high from the fourth quarter last year was 129.42. So today's low was 129.55. So we're 13 cents basically of that. But there's a few reasons to think that we have the potential to bounce in here soon. Now, there's no evidence at all that this market should be buy. We're still making lower highs and lower lows. We're still below a declining 5-day moving average. So don't misunderstand me. This is not a place to buy. This is where we should begin to look for evidence that it's possible this market may begin to bounce. So when we look at the market, we're going to say what are the relevant areas to measure, and we can look at really the October low where we had this little panic last year. Since that move, we can look at a couple things. One, a Fibonacci off of there and say what's a normal type of retracement. A 38.2% retracement is considered normal, and that would bring this market down to about 129. So, a lot of times the Fibonacci by itself is a reason that shorts will stop shorting because they'll say, hey, it's down to 38.2% retracement. Let's stop adding supply. Other people on the sidelines will say, hey, it's at 38.2%. Let's start to stick some bids in or cover some of their shorts and not only remove some supply from the market, but add a little bit of demand. Again, though, I need to point out there is no evidence that that's happening. This market closed pretty much on its low here again today. So that's, a second day in a row where it closed near its low. But the point is the psychology that begins to unfold is people will look at it and say, well, that prior level of resistance, which actually lines up with this little low right back in here as well from July of last year, that looks, that's been an important level in the past, so let's keep an eye on it now. They might, people who are looking at that just by itself might decide not to short or might decide to cover some shorts or might decide to deploy some sideline cash. So the point is we're trying to understand the psychology of what happens and where there might be a turn set up. We want to anticipate all potential scenarios but wait for price confirmation before we actually decide to get involved, and we'll talk about that as well. But the point is here we also can look at and say what's the average price that the market has traded at since there. So we can take a look at a volume weighted average price line, as I like to do. I'm just going to direct you to look at the pointer and see where that line begins to move. It's above it's above the pencil right now. It's now I'm lining it up, but it's averaging. What's the average price the spider has traded at in that time? And you can see right here that it's basically the level of that. And let's just bring this back and do it again so we can see the number. So what I'm going to do is direct you to look down here and look at that average price. Well, it's now disappeared behind there and I can't find it either, so that didn't work. Anyways, the point is we're basically pretty much right at the volume weighted average price since the event. That is, since the panic sell-off and the subsequent rally. And I can't get that to move above it. So anyways, that level is basically right in here at about 129.5. So this is a potential area where some demand might come for the market. market. It's the dollar cost average people are now breaking even throughout this entire rally. So we saw the break of the trend line. Obviously, we saw that the market formed this little inverted, this little head and shoulders pattern, broke the neckline. Now we're down towards the measured move target. That'd be the height of this. And I didn't talk about that a lot because the patterns a lot of times fail. This one worked well, and again, Peter Brandt nailed it in the Russell 2000. But we're at a potential turning point, and we've got that 200-day moving average just below it, about 120. 120. What is this? Let's 128. So 128.99. We've got the 200-day moving average. So it seems to me as though we're likely to encounter some support in this band, basically 128 to 129 and a half, where we currently are. And we want to wait though for price confirmation. That is, we want to see that this pattern of lower highs and lower lows at least begins to turn sideways a little bit. Now earlier in the week, I was looking at this market saying we have the potential to squeeze shorts if it could get back above these little highs in here. And that was a potential scenario, that if it got above there, it would be worth maybe a shot on the long side. Well, it never occurred. We also spoke about the IYR. Now here's a stock that, or the Russell, not the Russell, but the real estate index trust ETF. We were looking at this earlier in the week and saying, if it's to break beyond this little resistance, this market could rally. But instead, it didn't break it. So you want to buy the strength with a stop, that's based on the definition of trend. So if we had a higher high right here, it would have been buyable with a stop, worst case, below this level right here. So maybe a point and a half loss. It would have avoided the rest of this bloodbath in the IYR. But, I'd spoken yesterday actually about Amgen as well, how Amgen looked like it was setting up. The 71.18 level had been hit on Wednesday and then again yesterday. It didn't break that $71.18 level. And the people who, one of the lessons of this market right now is that when we have an overall declining market, you're going to get punished a lot more when you do those cheat buys. That is the anticipatory purchase. If we had a rip snorting bull market, then you could buy this thing. Probably you could have bought it yesterday at 71.05 and it would have been likely to break out and follow through. But since we don't have a strong market, if you're going to be making those anticipatory purchases before the momentum comes in and before it makes the higher high, well, you better have a plan to get out. And hopefully that was, if you did get involved, that you got out somewhere in here, because that was the lower low. But more importantly, the lesson here is not to get involved until the momentum is actually there and the buyers show their hand. Back to the markets though, the NASDAQ down pretty good as well, breaking below some key levels. Let's take a look at the volume weighted average price in here since the October lows, and that would be off of this level here. So we're pretty much right on that as well. The volume weighted average price about $60.60. If we look at Fibonacci in here off of the October lows to the recent highs, we're just beyond the 38.2% retracement. So that didn't help us. The point is, you don't buy at a 38.2% retracement. You don't buy at the volume weighted average price. You look to study the market on shorter term time frames and say, is there evidence that the buyers are in fact showing up, that the shorts are letting off some of the supply, that some of the longs aren't liquidating anymore, but they're still liquidating right into the close here. And the path of least resistance continues to be lower. We can look at all the potential support levels we want, and I think that would include basically where we are down to the 50% retracement and the highs from the fourth quarter of last year in here as well. So basically from 59.5 up to about 60.5 should be a band of support, but you don't buy it until there's actual evidence. Now, the frustrating part is when you're waiting and then it will just gap up one day. It doesn't seem like that's going to happen though. The Russell 2000 really, again, this one's just barely holding on, up 1.1% year to date. The volume weighted average price since the October low, we've closed below it now. So over the, since this recovery has taken hold since October of last year, the average participant in the Russell 2000 is now losing money. The prior resistance was not, did not hold his support either, and there was no reason to be buying as it broke down. We were looking at it earlier in the week, saying, maybe back above this 78.50 we could squeeze the shorts, but instead it broke down, and that pattern, the obvious head and shoulders pattern, is in fact working here. And you can come up with a price objective, which would be the height of the pattern, 78.5 up to, let's just call it 84.5. So what would that be? 6 points. Take that from 78.5, and that would give us a downward objective of 72.5. So is 72.5 going to be the level? Well, it could be. We just simply do not know. We want to look at, is there anything else that lines up in there? And not really. So, the more technical indicators you have kind of pointing towards the potential of support, the more likely it is that, we've got the psychology of these participants each coming to their own same conclusion, but for different reasons. If we can see what those reasons are without being too esoteric about it, like looking at the cycle of the moon, which on Sunday actually there's a lunar eclipse, which will be cool, solar eclipse rather, at least viewable here in Colorado. But you want to look at the things that are important. We've got a declining 10, 20, and 50-day moving average. From an intermediate term standpoint, we've got that declining 5-day moving average, and it's guilty till proven innocent until it can make a pattern of higher highs and higher lows above it. That didn't happen, so there's no reason to be a buyer. Semiconductors got smashed as well, as we had pointed out. The semiconductors this week were down 6.5%. For the month, down 10.5%, and just barely holding on to positive for the year. This market as well, we take a look at the volume weighted average price since it came not since it became public, I'm thinking about Facebook, since the October lows, we sliced below those as well. Prior levels of resistance aren't holding as support either. So the support just simply isn't being found. We still see lower highs and lower lows, and until we get that, even for day trades, we maintain below a declining volume weighted average price. Trade in the direction of the volume weighted average price. Look for the potential of a reversal in here, but if it doesn't do it, get out quickly, and otherwise, you're going to suffer the consequences, which are obviously bigger losses. The financials have broken two important levels of support in the last week and a half. First, that 14.95 that had held as support was this prior resistance, and now this $14.30 level was broken this week, and there's no signs that the sellers are letting up. We had, of course, J.P. Morgan with their loss, and in a Schadenfreude type of way, it's kind of good to see the guys who supposedly always make money screw up so badly. And anyways, not to root against Morgan Stanley necessarily, but everyone hates the bankers because that's all they do is make money, and it's tougher for us. But it's good to see them screw up. But it's doing damage to a lot of people in the financials as well because of their irresponsibility with their risk management and not doing their jobs they're supposed to do. The volume weighted average price since the October low, we've sliced through that in these financials, and the Fibonacci's we can see in here that we've sliced through the 38.2% retracement. So you look at this and say, well, this was prior resistance in here, that should become support. It was support over here, but it's not. It tends to resistance broken tends to act as support on a test, but there's no science to technical analysis. It's an art, and it's about managing risk and finding the consensus on the time frames. And the consensus is we're still in a downtrend. It's guilty till proven innocent. Let's talk about some of the stocks that everyone likes to talk about. Let's talk about Facebook. Facebook, has a one candle bar in the daily time frame. The volume weighted average price for Facebook right here is about $40.05. And that's after market. So basically, the average participant is down about $2 in here, or about 5%. If you bought this thing today, the average participant who bought it is down 5%. So that's not a successful IPO. They managed to hold it above 38. I bet you that will break next week, and you'll see an avalanche of little stops trigger. So if you're buying this thing at 38, thinking, well, I'll put my stop at 37.99, there's a lot of people I think have done that, and you're going to see that your 37.99 stop order might not get filled till 37.5, 37 even, because we're likely to see an avalanche avalanche of supply. Now, I'm not making any predictions about Facebook. There's simply not enough history to really look at it. It's a fascinating, it's fascinating to look at. 570 million shares traded hands in here today, and I mean, just massive volume. A nation of gamblers. 570 million shares traded. So it's just massive volume. Some of the little derivative plays that people were looking to get involved in, social medias like Ren, Yelp, Zynga, all got smashed. And Zynga, I want to point out in particular because I was, not making fun of, but I was talking about this one earlier in the week. And let me just find that little snowpack chart because I like to bring this up and show it to people because I'd mentioned it earlier in the week when Zynga had that bounce that it looks like the snowpack chart, basically meaning that you're in a downtrend. You're going to get these blips, but it's not enough to reverse the trend. And that's exactly what this little move was. It was a blip in a downtrend. Facebook or Zynga is in a horrible downtrend. Basically, everyone who's bought it is a loser. The public is, they did their secondary offering up at 12 and a half or whatever it was, and the only people who are making money in a stock like Zynga are the insiders who cashed out on the IPO and in that secondary offering. Anyways, so Facebook, it's going to continue to be a lot of attention, and it's going to need to settle down and prove itself here. There's a lot of unknowns, obviously, with that one and the valuation, and it'll be widely debated everywhere this weekend. Apple broke below its volume-weighted average price for the year this week. This is probably the most relevant, the little panicky low to measure a volume-weighted average price, and that comes down to $500 a share. We can also measure some Fibonacci on the Apple, and basically, we're at a 38.2% retracement of the. Well, I didn't draw that too well, did I? So let's delete that and retry it with a steadier hand. So a 50% retracement of that move would also bring us to the 500 level. So, Apple's still in a downtrend, lower highs and lower lows, maybe beginning to start to stabilize here, but, the evidence isn't there that the buyers are taking control. Let's see, what else did I want to talk about real quick? Oh, some ridiculous things. CHK, the news earlier in the week was that Carl Icahn was looking to buy this thing out, and it just got smashed. Don't listen to the headlines. Look at the stock. I mean, this is a snowpack chart. It's just a blip in a downtrend. There were rumors earlier in the week that Facebook was going to use its proceeds from the IPO to buy Research in Motion, and maybe they are. But look at this chart. Does it look like there's big accumulation? Does it look like a takeover target? Most takeover targets you see are already in uptrends because once they start buying, they tip their hand. And anyways, don't get caught up in these stories. Anyways, I've kind of gone on a little bit longer than I wanted to. Hope everyone has a good weekend. I'll talk to you next week. Thanks.